Well, I think the economic outlook for the global economy is looking positive, particularly in the emerging markets, and certainly in terms of an upturn in activity that we're seeing. We're seeing increased activity coming out of Asia, the Middle East, and indeed Sub-Saharan Africa and Latin America in particular. So very positive, very strong. Traditional markets for us, US is recovering well, so looking very good. And the UK is a safe harbour for a lot of our clients who are looking to invest in a market that's strong, well regulated, and it seems to be performing very well. So very positive.
Jersey has historically had a lot of private equity in real estate, and I think that will continue to be a big part of what we do. Within that, infrastructure is something that is really quite topical at the moment, quite hot, and debt funds is something we're seeing as well. Aside from that, there are more interesting assets, but they're like the clean tech, but we're not going to see those overtake the more mainstream asset classes, but those are an increasingly important part of the sort of diversity of investment structuring that you can do through Jersey.
Emerging markets growth is going to be very, very fragmented. Different factors drive different places. I think the very exciting part for me is probably Africa, where there's just such a huge sort of mixture of factors that are coming together. It's a real sweet spot. So we're seeing significant growth in the sort of growing middle class in a lot of African economies. So that's where I think there'll be particular activity.
I think the asset classes that are going to generate the best growth in the next few years remain real estate. In times of uncertainty, people still undoubtedly like to have bricks and mortar, and they like to be able to go and stand in their asset and look at it. And we certainly still see a lot of activity around that. Private equity, in terms of some of the emerging European markets and emerging markets elsewhere in the world, is an area of huge growth and interest. So I think those two principally, but we do ourselves a lot of work with clean tech. It's had a little bit of a rough ride in terms of some jurisdictional specific challenges such as Spain. However, there's still a great interest in that, and there is an energy crisis looming out there, and people are undoubtedly looking for alternative energy as an asset class, and there's a lot of interest in that.
I think it's a mix. It's going to be the businesses which reflect the growth of the markets in those countries. So everything that serves a growing middle class, whether it's infrastructure assets, whether it's commercial businesses that serve retail public, whether it's inflation-proof assets like real estate. It's also going to be some interesting alternatives in Africa, things like debt funds going into Africa, where banks maybe aren't in a position to do the credit lending that they need to.
I think as far as infrastructure is concerned, again, investors are looking for yield, they're looking for real hard assets, and they're looking for inflation proofing. So infrastructure again is a very, very hot topic at the moment, and one that's attracting huge amounts of money. We're seeing people, coming out of other asset classes, in particular out of gilts or bonds, and actually moving into infrastructure to get that pickup that they're looking for, as they believe that there's less value perhaps going forward in bonds and gilts. And I think finally the other aspect to look at is debt funds. Again, in the past 5 years, the top 30 debt managers in the world have raised over $320 billion worth of commitments, and currently there's something like 200 funds out there raising another $114 billion worth of commitments to put into that marketplace.
Yeah, it's interesting what's going to drive the market over the next couple of years. I think we're still in a phase where government policy is playing a big part in economics and the behaviour of markets. Low interest rates, quantitative easing have made have forced people to look at interesting assets to try and garner some sort of return. And a big question is, when that's reined back in and when that's eventually turned off, what will that mean? But I think there's a real sense of optimism returning to investors, so I think we can see I can see a sort of a managed progression back to normality and some long-term good prospects.